Okay, as they always say, what is more important, time or money? And I always say money is more important. Sorry, time. Time is more important than money. Time is always more important than money because once time has gone, you can never get time back. So whereas with money, you can lose money, but you can make it back. But once time is gone, you can never get time back. So time is always more valuable than money. So that's why I always start my seminars promptly. Don't wait for latecomers because time is more valuable. And of course, I always like to respect the time for those who've joined on time. So welcome and thanks for joining on time. For those of you who've joined on time, I'm going to kick off with introduction to investing in the financial market for millennials. And millennials is defined as from ages 22 to 38. But if you're less than 22 or older than 38, you're still welcome. But that's millennials 22 to 38. But like I said, if you're less than 22 or older than 38, you're still welcome to the fold. So we're going to be talking about the financial markets for 2 hours. Again, in terms of time management, like I said, we're going to start on time and we're also going to finish on time. So it's just going to be exactly 2 hours. And once the 2 hours is up, we're going to end. So we're not going to go beyond 2 hours. So the session is recorded, so you'll all get the recording later on today at the end, and also the handout. So you don't have to struggle to jot everything down. You'll get the recording and the handout at the end later on today. So the other thing too is that I'll try and limit the discussion to about an hour, the presentation, so that there's more than enough time for question and answers. Obviously, I'm not going to be able to teach you every single thing to do with the financial markets and investing. That's virtually impossible to teach you everything in 1 hour. But like the title says, it's just an introduction, give you an insight into investing in the financial markets, and just, a summary of what to expect when it comes to investing in the financial markets. But by no means can I teach or show you every single thing about the financial markets in 1 hour. And I'm sure you all appreciate that. But like I said, all this is just to introduce you, give you an insight, and hopefully get you thinking about, either acquiring more knowledge or begin to invest your money wisely and the way you approach the market. Okay, so without much further ado, let's kick off. Before we start this, just a quick disclaimer. And I'll also use that to just introduce myself to those who haven't met me before. My name is Dr. Aderemi Banjoko. The doctor comes from practicing medicine. I'm a medical doctor by profession. I qualified as a medical doctor in 1991 and been practicing medicine, well, specifically obstetrics and gynecology since 1993 in the United Kingdom. So as a gynecologist and obstetrician, I'm practicing in the UK since 1993. But all that time, I was actively involved in trading and investing in the financial markets, and also invest in the real estate market and doing business. So I've been an entrepreneur all that time and also actively trading and investing in the market. So basically what I'll be sharing with you and discussing with you is my over 20 years experience actively trading and investing in the markets. And also I used to be a guest lecturer at the Cass Business School while I was based in London. I used to be a guest lecturer in the Cass Business School teaching alternative investment management to undergraduates and postgraduates. But I quit medicine about 8 years ago. So about 8 years ago, I stopped practicing medicine, retired from medicine, and just went full-time into entrepreneurship, trading, and investing. So that's what I've been doing full-time. I moved back to Africa 8 years ago and set up shop initially in Nigeria and now based in Rwanda. And like I said, I don't practice medicine anymore. But that's just a quick background of who I am. And like I said, that's important because I just want to let you know I'm not a financial advisor. I'm not a broker. I'm not an accountant. So if you want professional advice, you can seek professional advice from qualified lawyers, accountants, brokers, and all that. But what I am is a private trader and investor in financial markets with over 20 years experience. And it's from that experience I'll be discussing and sharing with you all. So the aims and objectives of this session, like I said, we're not going to teach you every single thing about investing in the financial markets. That's virtually impossible in 1 hour. But the objectives that we're trying to achieve in this session is as follows. Number one is to discuss the importance of financial literacy, why it's important to be financially literate. Number two is to discuss the importance of compound interest and how you can begin to make compound interest work for you instead of working against you. And number three is to understand the aspects of the financial markets and risk. So understand what this thing called the financial markets, what is it? And most importantly, understand what risk is. You need to begin to understand what risk is. And then we'll conclude by discussing what a company is and the things you need to check from a basic point of view when you're looking at investing in a company. So this will be the main objectives for this session. Like I say, it's more of an introduction, and then we'll give you pointers as to where you can go to get detailed and further information. So these are the four main objectives of this session. We're going to highlight the importance of financial literacy, importance of compound interest, understand the different aspects of the financial markets, and like I said, most importantly, understand risk. And then we're going to discuss what a company is and the basic things to look out for when investing in a company. Okay, so we'll start with the first objective, which is financial literacy. Now, according to a Forbes article published in 2015, it showed that 43% of Americans and a whopping 2/3 of the adult world's population are financially illiterate. So you can see that from this study shows that financial illiteracy is a global problem. It's not a black or white problem. It's not a West or developing world problem. It's not an African or American or European problem. It's a global problem. The vast majority of adults globally are financially illiterate. So it's a big problem. And that's something that, I'm hoping that with sessions like this and getting people also, which is what I'm going to get you all to do, is to share this information with everybody, everyone the recording, the handout, do share it freely. This session itself is free because we need to sort out this problem of financial illiteracy. So what is financial literacy itself? How is it defined? Now, financial literacy is the ability to make informed judgments, and that's the key word, ability to make informed judgments and take effective decisions regarding the use and management of money. And that's a key thing to remember when you're thinking about money, is that what is informing your judgments regarding money. And that's what financial literacy is all about. It's your ability to make informed judgments. So if you want to invest, what's informing your judgments by investing? If you're saving, what's informing your judgments? If you're starting up a business, say for example, you want to open a fashion store, what's informing your judgment on that? If you want to open a restaurant or whatever business you want to start, what is informing your judgments? Because if you're making decisions based on ill-informed judgments, then you're going to lose a lot of money. And then now that you're well informed, how well do you take effective decisions regarding the use and management of money? So that's the definition of financial literacy. How well informed are you regarding what you do with money? And there's some key indicators they use to determine whether you're financially literate or not. For example, do you understand inflation? Do you understand the effect of inflation on your money? Do you understand consumer price index? Do you understand the importance of investing, saving? Do you understand the importance of compound interest? Do you have an investment account? So there are certain key things they use to determine if they will classify you as financially literate or financially illiterate. Because you understanding all these terms and how they work for and against you would influence how you then look at money and how you informed and how you judge what you do regarding money. So one of the things we'll look at to start with is inflation or consumer price index, which is also a very important way to start because once you begin to understand inflation and consumer price index, it's the same thing. Inflation rate, cost of living, consumer price index is all the same thing. They're just different terms for the same thing. So with that, you have to begin to understand how this affects you personally and in your day-to-day life. So what is consumer price index? I'm just going to quickly define consumer price index, or the short term for that is CPI. So consumer price index is just basically the rate of increase of basic goods and services over a period of time. So that's how it's defined. It's just defined as the rate of increase of basic goods and services over a period of time. So every country measures this consumer price index in their country, and they're just basically trying to find out how much the cost of living, the cost of the things that everybody uses on a daily basis, how much has gone up in value over a period of time. And they usually measure it over a year. So for example, would take you as an individual, take yourself as an individual. You wake up in the morning, you wake up in a house, so they will look at how much the cost of rent has gone up in a year. You know, you go and have a shower, they'll look at how much the cost of soap, toothpaste, toothbrush, how much it has gone up in a year. You get dressed, they look at, and the key word is basic goods and services. So they're not looking at flashy things. So for example, you get dressed, they'll look at the average cost of clothes, but they're not looking at the cost of designer clothes, basic cheap clothes that everybody can afford. You go and have your breakfast, they look at what's the average cost of eggs, milk, bread, you know, things like that. That's what they look at. You know, you want to go to work or to go to school or to go to your place of business or wherever, they look at the average cost for transport, average cost of an average car, petrol, and then of course, average cost for your phone bill, electricity bill, all this kind of thing. So these are the things they look out for, things that you all use on a daily basis. And they will take a sample of all these goods and services that we all use on a daily basis, and they'll find out how much they've gone up in value from the year before till now. So for example, we're in October. And like I said, every country does this, whether you're in Nigeria, Ghana, Canada, America, UK, Europe, wherever you are in the world, every country does this. So for example, we're now in October. So now that we're in October, every country is doing this at the moment. They would take a sample of all these prices I've talked about, cost of toothpaste, toothbrush, bread, milk, eggs, clothes, cost of heating, phone bills, uh, petrol, transport, everything that we all use on a daily basis. They will now take an average from across the country and see how much the average of these prices of all this basic goods and services has gone up from October last year till October this year, and the report comes out in November. And then they'll do the same in November. They'll find out how much all this basic goods and services have gone up from November last year till November this year, and the report comes out in December. So the report comes out every month, but it's obviously measured over a year. So let's stick with October. So if they say, for example, the cost of all these basic goods and services, if the cost has gone up, let's just say, for example, by 2% over the last year, then that means your baked beans, your milk, your eggs, your soap, all these things have gone up by a value of 2% over the last year. So for you just to maintain your basic standard of living and your basic lifestyle and be able to eat your bread, your eggs and all that, and pay your bills, that means your salary or your income also has to go up by at least 2% just for you to survive and not be in debt. And you can now see why understanding inflation or consumer price index is very important. Because if the cost of living, which is what the consumer price index has gone up by 2% over the last year, and your income, whether it be from your investment, your business, your salary, if it's not going up at the same rate as the inflation, then you're going to lack. And that's why most people run out of money before the end of the month, because their salary is not keeping pace with the cost of living going up. And of course, if that happens every month and every year till you retire, then you can now see why you're not going to retire with much money. You probably retire with lack. Because if the cost of living is just going up every year and your salary, your income, your investments is not going up at the same rate, then you can see logically you're going to struggle, you're going to run out of money, you're going to not be able to keep up with the expenses. So that's why you can now see why inflation or consumer price index is very important. You understand it because it affects you on a personal level. So the inflation gives you a benchmark for whatever country you're based in as to what you want to at least, you want your salary to be at least increased at the same rate as inflation. But of course, if you go back to the definition, we're talking of basic cost of living. And most people live above basic cost of living. Every iPhone, a new iPad, and all this stuff. You want to be able to buy good clothes and all that. So you can see that the vast majority of people live way above a basic lifestyle. So that means you want your salary to be increased by way above inflation. And of course, we all know that's going to be difficult because if you're an employee, the vast majority of us, you can't go and tell your boss to increase your salary way above inflation. They probably tell you to get lost. It's only the very, 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 very top managers in companies that can negotiate their salaries to be increased way above inflation every year, and they put it in their contract. But the vast majority of people, you don't have a say in your salary. In fact, especially now with COVID, most people have actually had their salaries cut, reduced, or of course, been unemployed. So you can now see that, understanding this inflation and knowing that your salary itself is not going to cut it. And you now have to start looking for other things that will give you a good return on your money higher than inflation. And I'll go again, this is why understanding inflation is important, because even if you set up a business, if you set up a business and your business is giving you, if inflation is 2% and your profit return in your business is 1%, then you're not making money. So you begin to see that whether it's judging the profitability of your business, your investment, your salary, whatever, you begin to see that you can judge it against inflation to see if you're doing well or doing badly. So let's look at some inflation figures from around the world. In the UK, these are all latest figures that came out this month. In the UK, inflation rate is currently 0.5%. And again, that's just because of COVID, as it has fallen. But usually you'll find that the inflation is going to rise as COVID situation gets better in the UK, and it's usually about 1 to 2%. But let's even look at 0.5% in UK. So if your salary is not increased every year by 0.5%, then you're in trouble. If you have savings, investments that are giving you a return of less than 0.5%, then you're in trouble. And like I said, most people tend to live way above a basic lifestyle. So ideally, you want to be earning way above 0.5% in UK. You want to be earning 2, 3, 4, 5, 6% in the UK return on your investment, your business, your salary, so you can live a comfortable life and not lack. So that's the UK's inflation for this month. In Germany is minus 0.2%. In the Eurozone is 0.4%. In the US is 1.4%. In Canada is 0.5%. In Japan is 0%. And then in Nigeria it's 13.71%. So in Nigeria, if your salary is not being increased by 13%, you're not getting returns 13% or higher, then you're not really making money. So you can see this importance of understanding inflation, and you begin to get a sense of the situation you're in. And again, this is part of why financial literacy is important. And this is one of the indicators when they use to determine if you're financially literate or not, is whether you understand inflation rate or consumer price index, because you can now see why it's important. Begin to see how this affects your earnings, your investment, your business, and you now need to know how you determine whether you're making money or not. So that's just another cartoon showing the effects of inflation or consumer price index. There's a chap who's gone shopping, and by the time he gets to the counter to pay, the prices have gone up. So that's just showing you, say, what do you mean the prices have gone up since I got in line? That's just an exaggerated example of what inflation is. You know, the cost of basic goods and services going up. So the next thing we're going to do is to talk about compound interest. That's our second objective for today, is to discuss compound interest and the importance of compound interest. And this is just a quick chart to show you if, comparing a 10% compound interest over 20 years. This is the blue line shows $1,000 with no interest. So $1,000 today will still be $1,000 in 20 years if there's no interest. Of course, inflation, as you've just understood from the last section, would completely erode the value of this $1,000. Then this is the red line is showing interest of 10% over 20 years, but no compounding. This is what you call simple interest. Well, that 1,000 becomes 3,000 in 20 years. But you can see with compounding, you can see the growth is exponential, which is what you really want. So I will say, which do you prefer? Which do you prefer? Do you want me to give you £1,000 every day for 30 days? Or do you want me to teach you? Do you want me to teach you how to double 1 pence every day for 30 days? So do you want £1,000 every day for 30 days, or teach you to double 1 pence every day for 30 days? So £1,000 per day, every day for 30 days is 30,000 pounds. Of course, wherever you are, you can change the currency. So if you're in Canada, you can change the pound to Canadian dollar. If you're in America, you can change that to US dollar. If you're in Nigeria, you can change 1,000 pounds to 440,000 naira, whatever the equivalent is. But the principle is the main thing, is understanding the principle. So 1,000 pounds per day for 30 days is 30,000 pounds. But 1 pence doubled every day for 30 days is 2.6 million pounds. So you can see that, and the reason why 1 pence doubled every day for 30 days comes up to 2.6 million pounds is the power of compound interest. And that's why you can now see the concept of compound interest, how we can make a bit of money grow exponentially over time. Obviously, 1 pence doubled every day means you're getting 100% return every day, which won't happen. But this is just to show you the effect of compound interest. So with 1 pence doubled every day means, you know, day 1 is 2 pence, day 2 is 4, day 3 is 8, day 4 is 16, 32. So if you do that for 30 days, you get to 2.6 million pounds. So this is just to show you the power of compound interest. That's why you want to earn compound interest on your money. So like Albert Einstein says, it says the greatest mathematical invention known to man is compound interest. So prosperous people earn compound interest. So prosperous people are always looking where they can invest their money to earn compound interest. And this is where we talk about passive income and making your money work hard for you instead of you working hard for your money. And the way you make your money work hard for you is by making sure your money is earning compound interest for you. So this is, you know, where it comes to. And this is what prosperous people do. They're looking to earn compound interest. Whereas with poor people, they tend to pay compound interest. And the way you pay compound interest is obviously from debt, loans, especially credit card debt. And that's where you are the one paying compound interest instead of you earning compound interest. This is just another quote from Warren Buffett. He says, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." So you can see that's really what you want to start doing, is looking to earn compound interest. And again, this is another thing that they look for when they're trying to determine if you're financially literate or not. So like I said, number one is you understanding consumer price index and inflation and the effect on your money and your daily life and your salary and your business. And also now you understanding the effects of compound interest, and you now seeing how you can make compound interest work for you instead of against you. So this is another example to show you the power of compound interest. So for example, just by you saving £1 a day, just £1 a day can help you generate £1 million. Again, you can convert that pound to whatever currency you are, wherever you are in the world. But basically saving £1 a day, which is £30 a month, can generate you £1 million. It all depends on what annual interest rate you are getting on that investment. So for example, if you're doing £30 every month and you're getting an annual compounded interest of 3% a year on £30 every month, you will get your £1 million in 150 years. Okay, so let's jump to 10%. So for example, if you're doing £30 every month and you're getting a compounded annual return of 10% a year, then you get your £1 million in 59 years. Okay, so £30 every month, getting an annual compounded interest of 10% a year, you will get your £1 million in 59 years. Now, you might still say to yourself, that's still a long way away, 59 years. But how do you shorten that duration? And then the simple answer to shorten that duration is to just invest more money. It's just as simple as that. So like I said, £30 a month, compounded interest of 10% a year, you get your £1 million in 59 years. And if you want to shorten that duration, it's as simple as just you investing more. So instead of doing £30 a month, you do £50 a month, or you do £100 a month, or you do £150 a month. So the more you invest, the shorter the duration. Next question is, where will that more money come from? Well, that more money will come from you just have to begin to value money now. You now see the value of money. What are you spending your money on? So you might just have to cut your expenses. You have to now see that, look, do I really need a new smartphone if my current smartphone is working well? Do I really need to, go to McDonald's or go and get a takeaway if you can avoid to? Because you now know that, if you invest more money, you can get your £1 million quicker. But that more money will just have to come from you cutting your expenses, looking to where you can save money, watching what you spend money on. So you can now see it all ties in, and you begin to value money, because you now know that with inflation is eroding the value of your money, you want to earn compound interest on your money. So instead of you putting your money in things that have no value or will lose value, you want to start seeing how you can put your money somewhere that will earn you compound interest, give you value, and most importantly, earn you compound interest. I'm just going to quickly show you this. Like I said, I can't teach you everything about the markets in a short time, but I'll just quickly show you an example of how you can earn an average of 10% a year. The quick one is using index funds. Index funds is a good way to invest in the stock market. This is the brokerage account I use in the UK. It's called Hargreaves Lansdown. But index funds, let me just show you an index fund that tracks the US market. But I think what I really want to do is just to show you that getting a 10% average return is not impossible, basically. That's really just what I just want to quickly show you. So if you've been investing in this Fidelity Index Fund, which is an index fund that tracks the US stock market, then you see once the site loads that the average return you'd have been getting on this fund is actually above 10% a year. And you can also earn compound interest by investing in this Fidelity Index Fund. Just hope it comes up quickly. Okay, we'll come back to that. While it's loading, let's carry on with the presentation. But I'll come back and show you that it should have loaded by the time we finish. Just don't want us to waste time, and because I also want us to have enough time for questions. So this is just to show you the power of compound interest, the power of value money, and you begin to look and think differently about how you use your money. Because like I said, if you want to get your money quicker, if you want to get your £1 million quicker, then you need to start thinking about how you spend money, how you use money, how you value money, and where you're putting your money. Actually, let me just come back to the site. So this is the Fidelity Index Fund. So you can see this is just the performance, the annual returns you would have been getting over the last 5 years. So you can see this is the return on this fund between 2015 and 16, 35% return, 16, 17, 13%, 17, 18, 10%, 18, 19, 11%. And even despite the COVID, the return from October last year to October this year is 14%. So you can see the average over the last 5 years is above 10% a year. So it just goes to show you that, it's not unrealistic to get a 10% return a year. That's just what I want to highlight and show you. Okay, so let's carry on. So now we've discussed the importance of financial literacy, and that was the #1 objective, the importance of financial literacy, why it's important to begin to understand, for you to begin to understand things like consumer prices, compound interest. We've just talked about compound interest, and we'll come to our third objective is now, because like I said, for you to begin to beat the return of inflation and compound interest, one of the quickest way you can do that is to start investing in the financial markets. So investment in the financial markets helps you begin to beat the return of inflation and get good returns on your money and compound interest. So that brings us to the third objective is, what is this financial market? So if you want to start investing in the financial market, you need to understand the aspects of financial markets. And most importantly, you need to understand risk, because there is some risk involved investing in the financial markets. So that's our third objective. So let's talk about what is this thing called financial markets and what is risk. So start off with, you need to understand that trading is significantly different from investing. They're two completely different concepts. So when you're trading, you need to think like a trader, and when you're investing, you need to think like an investor. And a trader is completely different from an investor. When you're trading, you're looking at short-term gains in the market. So as a trader, you're looking to get in and out of the markets within a couple of seconds, couple of minutes, couple of hours, couple of days, couple of weeks, or sometimes couple of months. Whereas an investor is looking for long-term gains. So investment, you're looking, where's the market going to be in 5 to 10 years? So very big difference. So trading is high risk because it's short term, and not everyone can be a trader. And investing is medium to low risk, and everyone should be an investor. So that's what I always say. I strongly believe everyone from the time they were born till the time they die should be an investor. So that's my own strong belief, and that's why I do free seminars like this, to encourage people to start investing, because I believe everyone should be an investor. But not everyone can be a trader. Not everyone can be a trader. It's a whole different ballgame. So like, again, Warren Buffett says, risk comes from not knowing what you're doing. And the reason why most people lose money invested in the markets or trading in the markets, because they don't know what they're doing. They're just guessing. And if you don't know what you're doing, then that's a huge risk. And it's because you don't know what you're doing. But if you know what you're doing, you can manage the risk and you can make a lot of profit from it. And like I said, that's what I've been doing personally over the last 20 years or more. I've been trading and investing in the markets. And it's been very good to me. And it's not that bad if you know what you're doing. So that's just that quote from Warren Buffett. Says, you really need to know what you're doing before you do it. Otherwise, that's where the risk comes in. So what are the financial markets? The financial markets is actually composed of 4 major components. There are 4 major components that comprises what we call the financial markets. So when you use that word financial markets, you're actually describing, or you're talking about 4 major markets. So these 4 major markets are, number 1, we have what you call the fixed income securities market. Well, the fixed income securities is where you talk about bonds and treasury bills. Second component is a stock market. That's where you have company stocks and shares. The third component is a currency or the forex market. And the fourth component is a commodities market. That's where you get oil, gold, coffee, wheat, and so on. So these are the 4 major components of the financial markets. So it's very important you understand that, because when you just use the word financial markets, you should know you're talking about 4 different markets. The fixed income securities market is completely different from the stock market. The stock market is completely different from the currency of the Forex market, and the Forex market is completely different from the commodities market. So that's very important you understand that from the outset. Because like I said, I do trade the markets and I also invest in the markets. Mostly when I trade, I mostly trade the commodities and the currency market. And when people ask me that, when I tell them I'm trading, they'll say, oh, that XYZ is happening to the stock market. And I keep having to tell them that, look, the stock market and what I'm trading is a complete different thing. So it's always very important you understand that the financial market has 4 major components, which are all have their own unique characteristics and their individual markets. The other reason why it's important to separate the financial markets like this comes when you're talking about investment risk. Now, investment risk just simply means your chances of losing money. It's as simple as that. When you hear investment risk, it means what are your chances of losing money. So if they say something is low risk, it means you have a low chance of losing money. If they say something is medium risk, it means you have a medium chance of losing money. If they say something is higher risk, it means you have a high chance of losing money. So risk just means your chances of losing money. Low risk means low chance of losing money. Medium risk, medium chance of losing money. Higher risk, high chance of losing money. So we'll start with low risk. So if you have a low risk appetite, i.e. you're so a person that you'll be depressed if you lose £1 or £1 or 1 cent, then you're low risk. Then with low risk, which means low chance of you losing money, the only financial market that gives you low risk is the fixed income securities market, i.e. investing in bonds and treasury bills. That, unfortunately, is the only financial market that gives you low risk, the fixed income, buying bonds and treasury bills. And as you can see from the slide there, the annual returns you get are poor. So in the UK currently, the annual return on the UK bonds and treasury bill is about 0.62% a year. In Nigeria, it's 5.13% a year. And I mean, with an inflation of 12%, you can see that's worthless. So you can see you can't really make much money investing in fixed income securities. But unfortunately, that's the only one that gives you low risk. So you might have to take some risk, but not a lot. And this is where long-term investment in the stock market comes in. This gives you medium risk. So the risk goes up, so you might lose some money. So there's a risk you could lose some money. Never forget that when you invest in the stock market, there is some risk involved. It's medium, but it's medium risk. But never forget that it's not 100% guarantee. There are no guarantees. So there's some risk involved, but the longer you invest, the better. So long-term investment in the stock market is the best one to go for if you're looking for something that will give you good returns with medium risk. And as you can see, the US stock market returned 29% last year. And I just showed you from that US index fund that tracks the US stock market, you can see the average return over the last 5 years have been above 10% a year on the average. So you can see that's much better than fixed income, but there's some risk involved, but it's medium risk. Never forget that. Then finally, we come to high risk. And high risk means exactly what it means. High risk means high chance of you losing money. High chance of you losing money. And this is where trading comes in. So when you hear the word trading, it's automatically high risk, means you could lose all your money. So if you don't have a high risk appetite, you don't go near trading. But if you want to trade, the best market to trade is the currency or the commodities market. And cryptocurrencies also falls into high risk. Okay, so this is very important because unfortunately, subconsciously, what most people are looking for is the holy grail. Most people are looking for an investment that will give them 100% return, but guaranteed with zero risk. And this is where people get scammed. This is where people get ripped off. This is where people get duped, because people are subconsciously looking for an investment that will give them 100% return guaranteed. It does not exist. It does not exist. Once somebody is promising you something with 100% return, to me, that's always a red flag that that's fake, that's a scam, and they're just looking to rip you off. It doesn't exist. This is where all these pyramid schemes come in, Ponzi schemes, where you just get yourself into trouble and lose money. And it always ends up in tears, because the reality, which people don't want to hear, is that the reality, if you want high returns, you just have to take risk and you could lose money, period. If you don't want to take risk and you want low risk, then you just have to settle with very low returns. That's just a fact. Anything other than that, people are lying to you. They're trying to rip you off. They're trying to, scam you and get you involved in things where you're probably going to end up in tears. So it's as simple as that. High risk, high returns. So as you can see from this slide, with low risk, you get low returns. With medium risk, you get medium returns. With high risk, you get high returns. But with those high risk, that means you could lose your money. You could lose all your money. With medium risk, yes, the returns are good, but there's a chance you could lose money. So that's why understanding and accepting risk is very important. But again, going back to the Warren Buffett definition, if you know what you're doing and you know how to manage the risk, you could reasonably do okay. But you need to understand risk. That word guarantee is what everybody's looking for. And yeah, it doesn't exist. So finally, our final objective for today is to talk about company. What is a company? Like I said, this is a session for millennials aged 22 to 38. Well, like I said earlier, if you're on the call and you're less than 22, you're welcome. If you're older than 38, you're welcome. But ideally, I always say with millennials, they should really be looking at investing in the stock market for the long term, because you have time on your side, and you should really take advantage of that time. Because like we showed you, with long-term investment, if you're looking to invest in the long term over the next 5 to 10 years or more, there's a good chance you will do well. And if you're a millennial and you've got age on your side, you should be looking at investing in the stock market as soon as you can, because you've got time on your side. Millennials, or even those, I always advise people from the age of 14. By the time you're 12, 13 and above, till about the age, your early 30s, you should not really be investing in bonds and treasury bills. Bonds and treasury bills should not be what you should be investing in if you're in, age 12 to early 30s. You should really just be looking at the stock market because of the time on your side. So let's talk about this quickly. What's a company? It's very important you just understand quickly what a company is. The definition of a company actually tells you what you should be looking for when you want to invest in a company. Obviously, there are more analysis and there are more in-depth things you need to do before you choose a stock, but I just want to show you that it's not rocket science. Just by understanding the definition of a company, that in itself begins to tell you what you should look for before you invest in a company. So what's the company definition? So this is a Cambridge Dictionary definition of a company. It's defined as an organization that produces or sells goods or services in order to make a profit. So I'll repeat that. The definition of a company, according to Cambridge Dictionary, is an organization that produces or sells goods or services in order to make a profit. So you can see, and I've already highlighted there in red, the definition alone of a company tells you straight away what you should be looking for in that company before you invest in that company. So if you're looking at a company, you need to know what are they producing or selling? What are their goods or services? So you can see that's a basic question you need to answer when you're looking to invest in a company. And some people, that's why they lose money investing in the stock market or in companies, because they don't even know this basic thing. They invest in companies without even knowing what that company does, what their services are, what their goods are. And of course, when you're looking at what they produce or what they're selling, you also have to logically find out, is there a demand for their goods and services? So I use a good example. For example, Amazon. Everybody knows there's a huge demand for Amazon's goods and services. That's why Amazon is doing fantastically well as a company. We're now having a Zoom session. This session we're having with this seminar is with Zoom. And there's no surprise that the company is doing phenomenally well because there's a high demand for Zoom services. And then if you look at the flip side, because of the COVID-19, the lockdown, the travel restrictions, the airline industry is doing very badly. So the stocks and shares for airline companies have fallen. They're all at the rock bottom because there isn't a demand for their goods or services. So you can see it's not rocket science. By the time you look at it from, even just from the definition of a company, begin to decide which companies you are thinking of investing in or not, because by the time you find out what that company produces or what they sell or what their goods or services are, and if there's a demand for it, then you begin to know which companies to look at or which companies to avoid. Of course, the gaming industry is an industry that is booming and is actually, obviously, it was booming even before the COVID, but it's doing even much better with the COVID. So again, with the gaming industry, you know, there's a demand, it's a growth industry. So you may be looking for companies that are in the gaming industry to invest in. So you can just see, just from the definition, that already begins to give you an objective way to look at companies to invest in. So it's not just, you know, looking at a company at random. You need to find out, what does this company do? What do they produce? What are their services? And most importantly, is there demand for their goods and services? And then finally, are they making a profit? Are they a profitable company? I mean, that's why you have charitable companies. I mean, charities, charity organizations. And that's why charity organizations are called not-for-profit. So of course, if you want to do an investment and make money, you want to make sure that company is making a profit. Otherwise, you're investing in a charity. You're not going to make money. So you can see from the definition, when you're looking at a company, you want to know what they do, and most importantly, are they making a profit? So you can just see that, yeah, it's not rocket science, it's not guesswork. And if you think about these things logically, you can make logical decisions in deciding what to or where to invest. So like I said earlier, you know, yes, I've just given you an insight. This session, like I said at the beginning, is just an introduction. There's no way I can teach you everything about the stock market, choosing stocks, analyzing and all that. So yes, there's still some other things you need to do, you know, assessing this company's involvement, like I said, what they do. You need to examine the financial data, the management, the business concept, and the competition. But like I said, it's just an introductory session, just to give you an idea that this thing is not rocket science. There's some logic to it, and there's some common sense into how you choose wisely and objectively what to invest in. Now, when you buy stocks or shares of a company, you own part of that company. So that's another reason why you want to know about the company you are buying stock in. So for example, if you buy stock in a stock or a share in Nike, then you're part owner of Nike. So if you like Nike brand and you're a Nike fan and you have Nike sneakers, then if you believe in that company, then you can just become a part owner. So even if you buy just one share in Nike, that makes you a part owner of Nike. So buying shares in Nike, whether it's just 1 or 2 shares, you're already a part owner. Of course, you'll be a 0.0000000 something percent owner of Nike. But by buying stocks or shares, stocks and shares are the same thing. Whether you talk about stocks or shares, exactly the same thing. So by buying stocks or shares of a company, always remember that you now own part of that company and you're now a stockholder or a shareholder in that company. So another reason why you want to know about that company. And another reason why you can see, choosing which company to invest in. If you look at the thing you're already spending all your money on, if you're a huge Apple fan, I have friends who they're from their TV to their wristwatch to their phone to their laptop, they're just Apple fans, but they don't invest in Apple, which is sad. So they're just paying Apple for all these products. You might as well invest in the company. Since you believe so much in the company, you might as well own part of that company and become a shareholder in that company. Same with Nike. We know there are some people who are Nike heads. They probably have 100 Nike sneakers, but don't own a single share in Nike. So you get to think about it, that if you use all these products, Samsung, if you use all these things, you might as well become part owner, since you believe a lot in the product and the service. But yeah, it's just remembering that when you buy stocks of a company, you're now a stockholder. Now, when you buy shares, you expect them to increase in value over time. And like I said, you want to make money from them. That's why you're investing in them. It's not for charity. You want to make money. You want to have a good return on your investment. So when you buy shares, you expect them to increase in value over time. So if you buy it at $5 a share, you're hoping it will go to $6, $7, $8, $9, $10 a share and increase in value over time. Some companies also pay you a portion of the profit. So some companies, for example, if you bought Nike and Nike made a huge profit, they will share the profit among the shareholders and you get a portion of the profits. And that portion of the profit you receive is what you call dividends. So some companies, not all companies pay dividends, but some companies do pay you a share of the profit they make, and that what they pay out is called dividend. That share of the profit they pay out is dividend. So there are 2 ways you can actually benefit from investing in stocks and shares. So you can profit from the value of the stock going up, which is growth, and you can also benefit from also getting a portion of the profit paid out to you as dividend, which is income. So that's the beauty about investing in stocks and shares. You can benefit from growth or getting income from dividend payments. But remember that the value of a stock is not fixed. Very important to remember that. So the stocks do not have a fixed value or price, and this can change at any moment. And when we say change, that means it can change for the better or it could change for the worse. So if you buy a stock at $5 per share today, tomorrow it could drop to $4 or $3, or it could go up to $6 or $7. So they don't have a fixed value. And that's why we talked about the risk. There's a medium risk involved. So there's some chance you could lose money, but it's medium, not high. It's medium, especially if you choose wisely, if you choose the company wisely. But yes, always remember that stocks do not have a fixed value or price, and it could change at any moment. And things like market conditions, like we have now with the COVID, investor perceptions, and investor perceptions is not objective, and other factors such as the products, the service, and the profitability. All these things can affect the value of a stock either in a positive way or in a negative way. The other thing you need to just be aware of that stocks can have what we call cyclical stocks, which is a stock that rises quickly in value when the economy of the country is growing and strong, and also falls rapidly when the economy of the country too is falling. Again, like we have now with the COVID, most cyclical stocks are doing badly during this COVID period because they go up and down as the economy of the country goes up and down. And of course, an example is, the car industry, the housing market. Obviously, when the economy is bad and people are out of jobs and they're not making money, they're not going to be buying new cars or buying new homes. So this is what we call cyclical stocks. They go up and down with the country's economy. And then you have what we call defensive stocks, also called non-cyclical stocks. They're just called defensive, nothing to do with the military or arms or ammunition. It's just that they're not cyclical. That's why they're called defensive. You know, they're stocks that tend to remain stable even under difficult economic conditions. So some examples of defensive stocks include food, because regardless of the economic situation, people have to eat. Smokers will always smoke. And, you know, oil, utilities, especially in countries, Western countries like Europe, UK, America, and Western countries, utilities, whether the economy is good or bad, you have to pay your water bill, you have to pay your heating bill, you have to pay your gas bill, whether you like it or not. So this is what you call defensive stocks. So these are some other things you can consider when you're choosing companies to invest in as to whether they're cyclical or defensive. So finally come to the conclusion as we wrap up, and then we'll soon get into question and answers. Like I said, so now I hope you now appreciate the importance of financial literacy. And like I said, financial literacy is all about making informed, keyword, informed decision about money. And you can now see that, you know, you need to understand what consumer price index is, you know, because inflation can erode the value of your money, and it begins to make you understand why it's important to understand inflation, why it's important to be financially literate so you know what you're doing with your money and taking effective decisions regarding the use and management of your money. So we also talked about the importance of earning compound interest on your money, because like we said, you know, that's how you make your money work hard for you, by you earning compound interest. And you can see how you can make millions of pounds just from earning compound interest. So you can also see that that's what you need to be looking for. How can I earn compound interest on my money instead of you paying compound interest? And you can see how the concept of compound interest can make a tiny bit of money grow exponentially over time. And now I hope you now know different aspects of the financial markets, the fixed income securities market, stock market, currency, and the commodities market. And most importantly, you now understand risk. And, you know, don't let people scam you and dupe you, trying to tell you they're going to get high returns with no risk. Once you hear that, they're just a scam. So risk just means your chances of losing money, and there's low risk, which is low chance of losing money, which is the only market that gives you low risk of the fixed income securities market, where the bonds and treasury bills come in. You have medium risk, where you might lose some money, but if you don't want to lose a lot of money, the best market to invest in long-term is long-term investment in the stock market. And then high risk is high chance of losing money, which means exactly that. There's a high chance you could lose all your money. And if you have a high risk appetite, that's where trading comes in. And the best markets you can trade, which is where cryptocurrencies come in, trading the currencies or commodities come in. And then finally, we just told you how to quickly evaluate a company. And that's just from the basic definition of a company. You now know it's important to know the goods and services the company provides, if they're in demand, and also if they're profitable, and also, you know, having at the back of your mind if it's cyclical or defensive, and also knowing that you can, apart from earning growth in value of the stock you buy, you can also earn an income from dividends payment. So like I said, this session was just an introduction to give you an insight into the financial markets. Like I said, there's no way I can teach you everything about it in 1 hour, but it's just to give you an insight for you to begin to hopefully think differently, try to learn more about this, and try to think about what you do with your money, how you're managing your money. This is just also a testimonial just to highlight some of my students who've been for or clients who've been to our courses in the past. This is someone who attended one of my courses a couple of years ago in the UK, and she just applied the principles and been investing her money wisely, and she's grown her portfolio from £9,000 to £17,000. So she's done well, and she just sent me the message recently on the 15th of October. That's when she sent me this message about how she's happy about how well her investment portfolio has done. And this is another testimony I received just 2 days ago on the 21st of October. And again, this is someone who attended my course recently. And she was talking about she just got her first dividend payment. So, the stock she bought has gone up in value, and she's also got a dividend payment from the stock, which she was happy about. So yes, it's just to show you that this is just some real life examples of people beginning to apply the principles of investing, taking action, and begin to get good returns on their money. That's just a book I wrote on trading and investing, but this is the one I want to encourage you all. Like I said, the recording of this session will be shared with all of you later on today, and also the handout. So you're going to get this handout and the recording of this session before the end of today. So don't worry, all this will be in the recording and on the handout. But this is the one I'll strongly recommend for all of you because it's free. It's a podcast series. So you can get it on Apple Podcast or Google Podcast. So whether you have an Android phone or iPhone, you can get my podcast. You just search for Trading and Investing with Dr. Forex. Well, that's my nickname that my cousin gave me because I trade the Forex market and I'm a medical doctor. So she used to call me Dr. Forex, which is stuck. But it's free. Obviously the podcast is free. So that's the key. That's why I really want to highlight this, because the podcast is free. You don't have to pay for it. You can get free information. I discussed quite a few topics on trading and investing on that podcast. So do take full advantage of the podcast. Like I say, it's completely free. Listen to it. Feel free to share it with your friends, your colleagues, your family, completely free. Just go to Apple Podcasts or Google Podcasts and search specifically for Trading and Investing with Dr. Forex. And you can get free information from the podcast series I recorded there on different topics on investing and trading. So do take full advantage of that free resource. Okay, and like I say, you're going to get this handout and the recording before the end of today. So, if you don't receive it before the end of the day, you send an email to our support team at info. I'll show you the email shortly at info@nextgenflx.com. But do check your spam email because sometimes the email might go to your spam. So like I said, we do run online trading and investing courses for those who want to learn more in depth. We actually have a specially arranged course coming up this November, which costs £150 per person. And the dates are on there. But if you want to join this course, again, you need to email us at info@nextgenflx.com. Because it's a specially arranged course, we're not really advertising it much, and it's not on our website. If you go to our website, you will see the next course on our website is in January, and that's £300 per person. So if you go to the website, the next course you will see starts in January, and the cost is £300 per person. But this specially arranged course starts in a couple of weeks, and it's not £350, it is just £150. But if you want to register and make payment, you need to send us an email at info@nextgenflx.com if you want to join that course. And again, this is just for millennials. Again, millennials being 22 to 38. We've created a website where, like I said, we're going to have a time for questions and answers now, and I'll try and answer all your questions before we finish, but we'll finish 2 hours on the dot. But we created a website where you can still ask questions after today on this site. I've created this site. So it's an online community for millennials. So if we will share the link again with you with the email that will be sent out to all of you. So you can go to the site, you can join. It's free. It's a free online community for millennials aged 22 to 38. Again, I post tips and advice on investing and trading on the platform, and you can also ask me questions on the platform. So that's a platform you can join for free. And again, feel free to share with fellow millennials. It's free, completely free. It doesn't cost any money. So we will share that link with you with the email that will be sent to all of you with the recording and the handouts before the end of today. And we'll also send you this invite link that will enable you to join the platform easily. And that platform also comes with an app, so you can also access the platform via an app. Let me actually just quickly go back to the website. So if you go to the website, if you scroll to the bottom of the website, it tells you about the app. You download this Mighty Networks app. That's the logo for the app. But the app is called Mighty Networks. It's available on iOS and Android. But you first have to create an account. So you first have to create an account. So you have to create an account with your email and password. And once you've created that account, you can then access the platform either from the website where you can sign in, or via the app where you can then sign in with the account details you've already registered with. But you have to register first, and then you can then download the app and access the platform via the website or the app. But like I said, we'll share these links with you, the website link and the link to join the platform with the email that will be sent out later on today. And those are our contact details. So like I said, that's our website. But most importantly is the email address, info@nextgenflx.com. Oh, the .com is missing, but obviously that's .com. That's info at, let me actually put the .com there. That's weird. So it's info@nextgenflx.com. So like I say, if you're interested in the, obviously, if you want more details, you're interested in the seminar, you want to register, just email us at info@nextgenflx.com, and our support team will respond to your questions or queries if you have more questions or queries regarding the seminars and the courses. Like I said, if you have questions regarding investment and all that, you can, after this session, you can obviously do it on the online platform. The info is just if you're having questions or queries regarding the courses. Don't send questions regarding the stock markets to info because the support team won't be able to answer those questions. They can only answer questions really regarding customer service, the courses, how you can register for the courses, how you can pay for the courses. That's what they can answer. They won't be able to answer any questions on the financial markets or trading or investing. And obviously those are social media handles. Okay, any questions? So if you have any questions, you can either raise your hands or send your question through the chat box. Okay, let me start with the chat box. But like I say, in the meantime, you can raise your hands if you have any questions that I can unmute you, but I'll start with the chat box. I'll just go through one at a time. Okay, we've got some questions sent to me privately. You don't want to share with the rest of the group your questions. Okay, let me start with this one. It's a private text. What is the best platform to use for a beginner investor in index funds? There isn't like a best platform. What I'll just say is you should use any licensed, reputable broker. So any licensed, reputable broker. That's the key. Because you can really get index funds from any decent broker in the UK. Or even in the Canada, UK, USA, any reputable broker is good enough. We'll be able to get you index funds. Of course, if you're in Nigeria, you can access index funds from Nigeria. But if you're in the West, so if you're in Europe, UK, Canada, USA, yeah, any reputable broker would do. So there's no big deal with that one. Any reputable broker would do. The site I just shared with you was just my own broker in the UK, Hargreaves Lansdown, but any reputable broker. And then, I mean, if the broker can't get you index fund, then they're no good. You shouldn't be with them. But yes, I think that's the key. Any reputable broker would do. What are the best industries to invest in now during the pandemic? Again, like I said at the beginning, I'm not a financial advisor, so I'm not going to give you specific advice. Even when I do the courses, what I do is to teach people and guide them on how to make good decisions and how to analyze the markets well. But yes, I don't give people specific advice because you need to be able to do your homework, do your analysis yourself. And I don't want people blaming me that Remy said I should do X, Y, Z. Remy said I should invest in this and that. And then you lose money and then you blame me. So no, so I don't give you specific advice. So you will have to, from what I've just told you earlier, you need to decide where is the demand, which industries are there demands for, and there are a lot of people in demand for the products and services of that industry, which industry is there least demand. So you have to answer that question. And I think I already gave you some hints and some examples during the presentation. But yes, like I said at the beginning, I'm not a financial advisor, so I'm not going to give you specific advice. How quickly should you adjust pension fund allocations, quarterly, half yearly, or annually? Again, pension fund allocations all depends on your objectives, what kind of returns you're trying to get, what is your risk appetite, is it low, medium, or high risk appetite? So again, it depends on quite a lot of factors that will determine how often you adjust your pension fund allocation. Actually, there's a session I do during the course. Actually, let me show you quickly. There's a session I do during the investing course we do, or we run, called asset allocation, where I discussed that. But again, I discussed the asset allocation in context of what had been taught during the course. So again, like I said, that's the brokerage firm I use in the UK, Hargreaves Lansdown. I don't work for them. I'm not affiliated with them. They don't pay me any money. I have no relationship with them whatsoever. I just have to point that out. I'm just saying that's my brokerage account, but like I say, you could use any licensed, reputable broker in the UK. Now, if you go to our website, NextGenFLX.com, I just want to quickly show you the course program is on the site. But yes, it's just in response to that, your answer, there is quite a lot that goes into deciding how often you sort of analyze your portfolio. It all depends on what you're actually investing in and what your risk appetite is. Okay, while the site is loading, let me look at the other question. Okay, it's come up. So if you go to the website, like I said, if you go to our website, you go under courses, you can see details of the Forex trading course and the online investing course. But for the online investing course, like I said, the next course is on the 13th of January, which is £300 per person. Like I said, that's different from the specially arranged one, which starts in a couple of weeks, which you can email us for details, and it's on the handout. But you can see the program of the course. We talk about fixed income, index funds, stocks and shares, and then asset allocation. But that gives you an idea. Anyway, so let's go to the next question. Thank you so much for your time. Pleasure, Gabby, and for sharing your wisdom. This has been, okay, God bless you. Oh, thank you very much, Gabby. I may have to come out this session slightly early. That's fine. Yeah, so yeah, like I say, if you have further questions, best to do it on the online platform. That's where you can ask questions. Don't email questions about the financial markets to info@nextgenflx.com. They can't respond to you those questions. So if you have further questions after this session, send it to the online platform, not to info@. If you have questions about the courses and our services, then you send that one to the info@. Very important. Someone just saying they're not a millennial, just joined to encourage their son. That's good. Like I said, if you're less than 25 and you're over 38, you're still welcome. But for the online platform, you have to be 22 to 38 on the online platform. Okay. Thank you so much. Pleasure, Abby. Oh, that's a nice name, Abby FX. My best spent 2 hours in a long time. Oh, high praise. Thank you very much, Abby. Please, when should one sell a stock or share? Being a long-term investor, how long should one hold a stock or share before selling? Again, that depends. You have to have an objective before you buy a stock or share. The stocks, and again, it's difficult to advise you on that without context. And again, going back to our course, we have a whole session on investing in stocks and shares and investment strategies. I think just as a rough, again, be careful. I have to be careful the way I say this thing, but as a rough idea, yes, gone are the days where you hold stocks and shares for life. So I personally, if a stock loses up to 50% in value, I'll sell it. And then if it gets up to 100% in value, I might not sell it at 100% depending on where the market is at the time, and I might just write it out. So usually once I buy a stock and it's gained 100% in value, I start watching it slightly closely. And if it's still doing well, I'll leave it alone. And I do have stocks that have gone up 100, 150, 200, 300% in value. But certainly, I don't hold on to stocks if they've lost up to 50% in value. Once they've lost up to 50%, I get rid of them. But again, I'm just giving you a rough idea. But again, all this you have to put into context. And the crucial thing is why you picked that company in the first place. And that's always the mistake most people make when they're investing in stocks and shares. They might have just bought a stock on the whim or from just somebody telling them to buy it. But if you do your homework well and you made a very wise and objective decision about that company and then buying stock in that company, I think that's where the biggest work is. And that's the biggest thing you need to do is choosing the stock wisely first. Then when you've done that, the rest tends to take care of itself and it's easier. BioMe, first of all, thank you. Oh, pleasure, BioMe. What platforms would you recommend for investing in stocks and shares? Again, like I said earlier, any recommended broker would do. Sorry, any licensed, I say recommended, any licensed broker would do. Let me get rid of the sites. So for example, you could just say, I don't know where you are, but you could just say top brokers in UK. So any brokers. Let's see. So show you here the 5 best share dealing accounts in UK. So you could just do your research and just look for the top brokers. You can do the same in any country. So these are the best UK share dealing accounts for 2020. So you can see that it said IG, Interactive Brokers, Saxo Markets, Hargreaves. Oh, that's interesting. You can see Hargreaves' best offering for investments. I like that. So that's the one I use. So again, any licensed, reputable broker would do. Any licensed, reputable broker. And like I say, you can just do your Google research. Let's do top brokers in USA. So it's the same thing too. You can do the same in any country. Research for the top brokers, call them, find out their fees, if they have good access to the markets. Anyone will do. So there's, because again, I think what I should actually highlight is that the key is the investment. So for example, if you want to buy shares in Nike, you know, where you're going to make money is from the Nike shares going up, regardless of which broker you use. So it doesn't matter which broker you use to buy Nike shares. It is from the Nike shares going up that you will make money, not from the broker itself. So I hope you understand that. So if you buy Apple shares, it's Apple shares that will make you money, not the broker. All the broker is going to do is help you get the Nike share, or help you buy the Apple share, or help you buy the index fund. So the broker itself is just exactly that. They're just a broker. They're just going to help you execute your trades and help you get the shares you want or the funds you want. So that's why I said any reputable broker will do, because it's not the broker that will make you money. It's your investment in Nike that will make you money. It's your investment in the US index fund that will make you money. It's your investment in Apple shares that will make you money, not the broker itself. So yes, any licensed reputable broker would do. This is Leila. Thank you, Dr. Remy. Pleasure. Great session. Awesome. Oh, thank you, Leila. Oh. And this is Omori Shojo. Omori Shojo. I hope I pronounced your name right. Thanks so much for doing this. Pleasure. I wanted this information for a long time. Oh, I'm glad I gave you the information. Pleasure. I'll definitely be signing up for a course. Okay, you're welcome on board. Can you share 2 or 3 practical first steps to begin investing? Where do I begin? Yeah, of course, you need to open a brokerage account. Okay, I can give you some quick advice. Like I said earlier, I'm not a financial advisor, but yeah, I can give you some general advice. Because like I said earlier, for you to be able to access the stock market and buy stocks and shares and buy funds, you need a broker. You need to have a brokerage account. So yes, that's the first thing you need to do, is to open a brokerage account, because that's how you will access these markets. You can't go to the supermarkets to buy Apple shares or index funds. So yeah, you do need a brokerage account for you to be able to access the stock market. And the other good thing about brokerage account, for example, if you're based in the UK, for example, with this Hargreaves Lansing account, I'm able to buy within my UK brokerage account. I have access to the European market, the Asian market, the American market. So I have stocks and shares and funds across Asia, Europe, and America, and also UK via my Hargreaves Lansing account. So that's the advantage of a broker. So yes, number one, you need to have a brokerage account that gives you access to the financial markets and the stock market. So that's number one. And then again, for example, if you want to buy index funds, the minimum amount to invest to buy index funds is £25 a month. So that gives you a rough idea of how much you need minimum. So that will give you an example. So if you want to start buying index funds, for example, that's what you need. You can just open an investment account, and with as little as £25 a month, you can be investing in an index fund. Actually, while I'm on the Hargreaves Lansing website, the other reason why I like their website, which is hl.co.uk. Actually, let me just copy and paste it into the chat box. But the reason why I like their website is that anyone can use their resources for free. So you don't need to be an account holder with Hargreaves Lansing to use their website. Now, what I would advise, this is just for those based in the UK, because I know there are some people from Canada, Nigeria, and other parts on the call. But this is just for those based in the UK. If you go to their website, if you go to our services, You can also read about the tax-efficient investment accounts you can open, like stocks and shares ISA, junior ISA, SIP. So you can click on them and read the tax advantages for each of these accounts. But it's all there for free for you to read on their website. So you can go and do your homework there and find out about this tax-efficient investment accounts you can open if you're based in the UK. But those in Canada and those in the US, you also have tax-efficient investment vehicles you can use, investment accounts you can open, and you can do a research on that. Where was I? So yes, so that's it. Where do you begin? Maurice Joe, yes, I've said, where do you begin? Yes, by opening a brokerage account. In Nigeria, the brokerage account I use in Nigeria is Investment One Financial Services. That's the brokerage account I use in Nigeria. So in UK, to access the Western markets and the Asian, Western, European, American market, I use the one in UK. In Nigeria, my brokerage account is Investment One Financial Services. That's the one I use in Nigeria. In Ghana, I use Data Bank. And of course, in Rwanda, where I am now, I use CDH Capital. But like I said, wherever you are, the key is just to use a reputable, registered and licensed broker. But that's my brokerage account in Nigeria. Okay, thank you very much. Pleasure, Kemi. Okay, Abby, I've seen your message privately. Pleasure. Look forward to see you in November. Leila, thanks again for the presentation. Do you have any investment suggestions for people aged 45 to 50? Not that I'm that old. No one is old, Leila. You're fine. Well, you can start with index funds. Again, it really depends on your risk appetite. And again, that's why I'm always very careful giving people advice out of context. And I mean, like I showed you with the course we do is actually 10 sessions, 2-hour sessions, 10 2-hour sessions. So that's basically, if you say 10 2-hour session, that's 20 hours. So the investing course and also the trading course is 20 hours of teaching. So you can imagine trying to summarize 20 hours of teaching is very difficult, because that's how you get proper context. Because even if you're 70 years old, you might still have a high risk appetite. I know people who are in their 60s, 70s, and are still actively involved in the stock market, in buying individual stocks and shares of individual companies. So there isn't really one size fits all. It depends on your personal risk appetite. It depends on the knowledge you have. It depends on, which is, again, where the course comes in, because we give you all the knowledge and tools for you to make informed judgments as to whether you want to take medium, up a risk, low risk, high risk. It's up to you. Actually, let me quickly show you something. Because if you also go to our website, you can actually watch videos from a practical session from previous delegates. So you can watch videos where they were presenting, which is actually quite good, because you can see how they've gone from not knowing much about investing and presenting like professionals at the end of the course. So if you go to a website and you go to more, you can go to the testimonials if you want, but you go to more, and then under more, you will see the whole links for the website, where you go to the last one, videos of the practical sessions. And you can actually watch those videos that will give you an insight into what previous delegates have learned, and you can hear them analyzing the markets from what they've learned. But yes, that would be my advice, Leila. There isn't really specific advice for 45 to 50 years old. I'm 50 myself. I turned 50 in November, but I have a high risk appetite. So I'm still actively investing in stocks and shares and the stock market. So, so yeah, unfortunately, there isn't a one size fits all. It's you knowing and understanding the financial markets, understanding the financial tools, understanding ETFs, index funds, stocks and shares, bonds, and then knowing how to apply what to what and how to use all those things and make it applicable to you personally. Okay, I think that was the last question in the chat box. Any other questions before we wrap up? Like I say, you can either raise your hand or send your question to the question box. I think I've gone through all the questions in the question box. Okay, so like I said, while we wrap up, like I said, this was just an introduction to investing, just to open your mind and enlighten you that, you know, this money thing, you need to start to understand money, how to use money, how to make money work for you, and to show you that, you know, it's not rocket science, but yes, there is still more to learn and understand. Like I said, we're going to share, since you've all registered for this session, we're going to send you an email to everybody with a handout and the recording of this session before the end of today. If you do not receive the email from us by the end of today, then do send an email to info@nextgenflx.com and they will resend it to you. But like I said, do check your spam and your junk mail, because the email could go to your spam or your junk mail. Like I said, feel free to share the recording, the handout, and the knowledge with everyone. Like I said, if you have further questions regarding investing and all that, that question should be directed to the online platform. Like I said, that's a free online platform where you can ask questions, and I also occasionally post tips. Actually, let me log in and let me sign in and just show you what I mean. So like I said, do not send questions about the markets to info@nextgenflx.com. the only things you should send to info@nextgenflx.com questions about the courses and how to register and pay for the courses, and that's what you should send to info@. If you have questions regarding investing and the markets and business and all that, that should be sent on the online platform, which, like I said, will share you the link of the website and also the invitation link to how you can join. That is where you should send those questions. And like you can see, I also post information about the markets there. So you can see I talked about mutual funds 2 days ago, talked about investing. So you can see there are different posts. And of course, if there are any other seminars coming up, we will let you know. So you can go through all the information I've sent up, posted on there. And again, you can also ask questions on the platform. And again, like I say, it's 100% free, totally free for millennials aged 22 to 38. And again, you can share this link. You can invite interested millennials. It's open to everybody from the ages of 22 to 38. They're all welcome on board onto the platform. It's completely free. And that is where you should send your questions regarding the markets, entrepreneurship, or whatever. The only emails you should send to info@nextgenflx is just to do with the courses and registering for the courses, because they can't answer questions about the stock market or investing. They can't answer questions. So that's what this platform was created for, which, like I said, we'll share the link with you at the end of today. And like I said, if you don't get the email today, by the end of today, then email info@nextgenflx, they will send it to you. Okay, so I don't see any more questions and there are no hands up. So on that note, I wish you all a wonderful weekend. Enjoy your time, have a great time, keep safe, keep safe. And hopefully we'll catch up with you guys either on the platform or during the course. And like I said, also do take advantage of the podcast, which is completely free. So have a great time and God bless.